Hi, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment markets so you can understand what we see in the global landscape. Generally speaking, we had a little bit of volatility over the last, let's say, 2 to 3 weeks. It started to abate as of last week. Again, the pause that refreshes. One of the things I try to always educate on my TV, radio show, and of course to all of our clients is nothing goes straight up in a straight line, whether it's the stock market, bond market, real estate, or any other asset category. Sometimes, even though the economy is doing well, doesn't mean, let's say, this stock market is going to do well on the short term. Again, we had this little kind of pullback, 3-4%, nothing drastic, pause that refreshes, and then things traditionally start to move back up. The fundamentals are what really matters over the longer term. Are fundamentals good? Are they improving? Are earnings growing? Are corporate sales growing? Things of that nature. Is the consumer getting healthier financially? And we're seeing yes to most of those, and we're seeing this nice meandering upline. So that's positive overall. Again, what happens through any calendar year, and I'll give you some statistical numbers, 2 to 5% bounces down on almost all asset categories, whether it's the stock market, the bond market, real estate, gold, doesn't matter. You'll see these 2 and 5% movements up and down, often a dozen times in any calendar year. Doesn't mean you physically lost money for that year. It just means, you might have the market trade down 4% before it trades up another 8 or 9%. These things are pretty commonplace. If I look at last year in the bond market as an example, bonds are perceived to be safe investments, which they can be at times as volatile and as risky as the stock market. Yes, they can have a lot of risk to them, depending what kind of bonds you own. If you look at the bond market last year, most and many bond investors lost money last year in bonds, while the equity markets did quite well. So again, things can go up and down and they can have short-term correction factors, but it's what drives that correction factor. Is it short-term in nature, or is it something that's going to continue and get worse and worse? Recessions are what you want to avoid, major catastrophic slowdowns in the U.S. economy, which we are not seeing right now. In fact, we see this nice meandering uptrend in growth in the economy and the labor markets. So we like what we see. We always make adjustments to our portfolio as necessary. And remember, risk management for the major risk in a recession is how we try to manage our portfolios. We don't mind about this little short-term volatility. It's going to be commonplace even in a conservative portfolio. If you're a client of our firm, you have a question, call us. If you're not a client of our firm, call us for a consultation. There is a difference. We invite you to experience it. Have a safe and profitable day.